stop everything you are doing. If you are watching this, you are witnessing the definitive end of a financial era. While the mainstream media was busy obsessing over political theater in Washington and distracting the masses with bread and circuses, the tectonic plates of the global markets just shifted in a way we haven't seen in over a century. On January 7, 2026, the impossible happened. A financial event so profound occurred that it marks the violent birth of a new monetary order. Silver, the element argentum. Number 47 on the periodic table, a metal mocked for decades as the poor man's gold, just flipped NVIDIA in total market capitalization. Let that sink into your bones. NVIDIA, the poster child of the artificial intelligence revolution, the darling of Wall Street, and the supposed god of the 21st century tech boom, was just run over by a freight train of physical reality. For 15 years, we have lived in the everything bubble. We were told that data was the new oil, that AI was the new religion, and that physical assets were merely pet rocks left over from a primitive past. But as of this morning, that narrative didn't just crack, it shattered into a million pieces. The smart money, the sovereign wealth funds, the central banks, and the billionaire family offices has officially pulled the plug on the digital illusion. The great rotation from pixels to atoms has begun. This is not a drill. It is a declaration of war between a debt-based paper system and a resource-based physical reality. Today, we dive into why the $80 silver you see on your screen is the biggest bargain in human history, and why the March delivery cycle is about to trigger a global financial force, Majeure. The catalyst for this earthquake began during the early hours of the Asian trading session. While New York was asleep, a massive wave of institutional buying flooded the markets, pushing silver's total market capitalization to a staggering $4.65 trillion. In one swift move, it eclipsed NVIDIA, reclaiming its throne as the second most significant asset class on Earth, trailing only gold. But the real story isn't just the price, it's the systemic failure occurring in the plumbing of the market. We are currently witnessing a run on the bank in the physical silver market. To understand why this is a crisis, you have to understand the COMEX calendar. Historically, January is a non-delivery month, a ghost town where trading volume is low and almost no one asks for physical. Metal traders usually roll their paper contracts forward to March. However, 2026 has broken the script. In the first 72 hours of January, 4,697 contracts stood for immediate physical delivery. That represents 23.5 million ounces of silver being drained from the vaults in a month where nothing was supposed to happen. This is the equivalent of a massive line forming outside an insolvent bank at 3 a.m. The data shows that J.P. Morgan, the custodian of the world's largest silver hoard, was forced to issue over 60 delivery notices in a single day. They are raiding their own strategic stockpiles just to keep the lights on and prevent a total market default. The paper wall that suppressed silver for 50 years has been breached, and the smart money is no longer asking for cash settlements. They are demanding the bars. The geopolitical squeeze, silver as a weapon of war. Why is silver suddenly the most hunted asset on the planet? It is because silver is the Achilles heel of the modern Western economy. We are currently in the midst of a great resource war between the United States and the China-led BRICS Plus bloc. China has realized that they don't need to win a hot war if they can win the commodity war. Silver is the indispensable oxygen of the future. You cannot have an AI revolution without silver. You cannot have a green energy transition without silver. You cannot build a modern military-industrial complex without silver. By hoarding physical silver and draining Western vaults, China is effectively cornering the market on the 21st century. If the West loses access to physical silver, the Green New Deal dies, the AI data centers stop expanding, and the defense industry faces a catastrophic bottleneck. The forensic math, the great inflation lie. The mainstream media will tell you that silver at $80 is expensive. This is a mathematical deception designed to scare retail investors out of their positions. To find the truth, we must look at the inflation-adjusted reality. In 1980, silver hit a peak of $50, but what was $50 worth in 1980? You could buy a decent house for $60,000 and a new car for $5,000. Today, those same assets cost 10 times as much. If we use the government's own CPI, Consumer Price Index, The 1980 high of $50 is equivalent to $170 today. If we use shadow stats methodology, calculating inflation the way it was done before the government changed the rules to hide the truth, that 1980 high is equivalent to over $400 an ounce. At $80, silver is the only asset in the world trading at a massive discount to its price from 46 years ago. Real estate is up 10x. Stocks are up 20x. But silver is still coiled like a spring, trading at less than half of its fair value. A move to $200 isn't a moonshot. It is simply a mean reversion to historical purchasing power. See the death of counterparty risk. The flipping of NVIDIA represents a fundamental shift in what investors consider wealth. For 15 years, wealth was a digital entry in a database. But as the U.S. national debt climbs by $1 trillion every 100 days, the counterparty risk of the paper system has become terminal. When you own NVIDIA, you own a claim on a company that relies on the CEO's sanity, the power grid staying online, and the SEC's regulations. When you hold a physical ounce of silver, you own an atomic reality with zero counterparty risk. It does not require a central bank to print it, a CEO to manage it, or the internet to be functional. In a world of $36 trillion in debt, the only honest thing left is a bar of metal. The March deadline, a mathematical trap. The bullion banks and the shorts are currently trapped in a cage with a hungry tiger. They have sold hundreds of millions of ounces of paper silver that they do not physically possess. They assume they could always settle in cash or find metal in the open market. But the open market is broken. Premiums are skyrocketing, and the January anomaly has stripped the banks of their buffer. They are now heading into the massive March delivery cycle with an empty cupboard. If they try to buy silver to satisfy the March contracts, the price will go to $200 overnight. If they don't buy, they default. We are looking at the potential for force majeure, the point where the COMEX admits the vault is empty and tries to rug pull investors by offering devalued cash instead of the promised metal. We are no longer in a period of speculation. We are in a period of exodus. The flipping of NVIDIA was the ultimate market signal. It was the moment the world realized that you cannot eat an algorithm, and you cannot build a future on debt alone. The great rotation is accelerating at the speed of light. Trillions of dollars of paper profits are trying to squeeze through a tiny exit door into the physical resource market. It is like trying to push the entire volume of the Hoover Dam through a garden hose in a single second. The pressure is explosive, and the walls of the financial system are starting to buckle. The bullion banks have less than 60 days to find metal that does not exist. They are frantically calling refineries and mines, but the supply has already been spoken for by the East. If you are waiting for a pullback to the old days of $20 or $30 silver, you are betting on a world that has already passed away. The air pocket between $80 and $200 is empty. Once the market realizes that JP Morgan is scraping the bottom of the barrel, the panic will go exponential. The masses will wake up. The fear of missing out, FOMO, will kick in, and the dealers will hang up the sold out sign. So, I leave you with one question. When the March deadline hits and the paper system finally decouples from reality, what will be in your vault? Will you be holding the pixels of the past overvalued tech stocks and devaluing dollars? Or will you be holding the atoms of the future? The script has been flipped. The silver age has begun. Secure your position now while the exit door is still ajar. This is the rotation of the century. Don't just watch it happen. Be part of it.
Today is December 22, 2025. We're witnessing silver trading around the $58 per ounce mark, a price level approaching historical highs. However, in today's in-depth report, I invite you to temporarily look past the short-term price fluctuations on your tickers and focus instead on a structural shift that is occurring quietly but decisively beneath the market's surface. Typically, when an asset experiences a sharp rally, our immediate concern is whether the market is overbought. Yet, current analysis of capital flows and physical inventory data tells a completely different story. We are not looking at a short-term speculative bout, but rather the inception of a systemic supply crisis. My core thesis in this report is as follows. The silver market is entering a new phase of price discovery, driven by the convergence of three factors: a prolonged structural supply deficit, irreplaceable industrial demand, and most importantly, a paradigm shift in the strategic reserve policies of Eastern powers. Let us begin with the most critical macroeconomic factor that the mainstream media is largely overlooking: the actions of sovereign actors. 2024 marked a historic turning point when the Russian Ministry of Finance officially allocated a budget of $535 million, approximately 51 billion rubles, for precious metals purchases over the 2025-2027 period. What is notable here is not just the figure, but the asset class. For the first time in over 50 years, silver has been classified as a national strategic reserve asset, alongside gold, platinum, and palladium. Why is this a critical signal? For 170 years, central banks have demonetized silver, relegating it to a purely industrial role. Russia's move represents a reversal of this century-long trend. Analyzed through the lens of geopolitical risk management, this is a calculated move to sanction-proof national assets. Following the freezing of $300 billion in foreign exchange reserves in 2022, nations like Russia and the BRICS Plus bloc have realized a hard truth. Only physical assets located within domestic vaults are truly free of counterparty risk. Alongside Russia, we must address China, the world's factory. Although China possesses the world's third-largest silver reserves, approximately 70,000 tons, import data reveals an unusually voracious appetite. China currently controls over 80% of global solar panel production and is growing its electric vehicle manufacturing at a rate of 40% annually. Both industries view silver as an irreplaceable input material. If we examine China's gold accumulation model from 2015 to the present, there is a strong basis to assert that Beijing is applying a similar strategy to silver: strategic accumulation to secure its industrial and technological dominance for the coming decade. The fact that the world's second and 11th largest economies have simultaneously shifted to a net buyer status for physical silver will create a hard price floor, regardless of short-term currency fluctuations. Now, let us drill down into the specific numbers from the Silver Institute and global mining data. A value investor always looks at the fundamentals, and silver's fundamentals are currently in their most severe state of imbalance in modern history. 1. Structural deficit. We are entering the 5th consecutive year of a silver market deficit. In 2024, total demand reached 1.16 billion ounces, while total supply, including mining and recycling, reached only 1.01 billion ounces. This resulted in a deficit of 148.9 million ounces in a single year. If we calculate the cumulative deficit from 2021 through 2024, the world has consumed a net deficit of 678 million ounces of silver. To put this in perspective, this figure is equivalent to wiping out 10 months of total global mining output. This volume has been drawn from above-ground stockpiles and consumed permanently. It is not returning to the market. 2. Inelastic industrial demand. Unlike gold, which is primarily an investment asset, silver is an essential industrial metal. Industrial demand hit a record 680.5 million ounces in 2024. The primary drivers are the renewable energy and high-tech sectors. 3. Supply inelasticity. This is the Achilles heel of the supply side. Approximately 70% of global silver output does not come from primary silver mines, but is a byproduct of copper, zinc, and lead mining. What does this imply? It means that even if silver hits $100 an ounce, mining companies cannot simply increase silver output if the prices of copper or zinc do not justify expanding operations. Furthermore, supply from primary silver mines is in secular decline, as easily accessible high-grade deposits have been depleted. Permitting and constructing new mines takes 5 to 10 years. We cannot expect any short-term supply surge to alleviate this pressure. As risk managers, we must pay particular attention to the state of certified inventories. This is the market's liquidity buffer, and this buffer is thinning at an alarming rate. At the COMEX USA, registered silver, inventory available for immediate physical delivery, has plummeted by over 50% from 152 million ounces in 2021 to approximately 73 million ounces by late 2024. In London, LBMA, inventories are also at record lows. After deducting holdings allocated to ETFs, the actual free float remaining is negligible. The danger lies in the leverage ratio within the paper market, derivatives. Currently, open interest on the COMEX exceeds the actual physical silver involved by multiples. The ratio of paper claims to registered ounces is at extreme levels, estimated around 18-1. This creates a risk of a short squeeze, similar to the nickel event on the LME in 2021, but on a much larger scale. When sovereign nations or major industrial entities demand physical delivery instead of cash settlement, the market will face an immediate liquidity shock. The divergence between the spot price and the actual cost to secure physical metal, physical premium, will widen. In such a scenario, the price listed on the exchange may no longer reflect the true value of the metal. So, is the current price of $58 to $61 the top? To answer this, we must place it within the context of comparables and inflation. First, regarding the gold-silver ratio. The ratio currently sits at 72-1, with gold at near $4,200. The historical average typically ranges from 40-1 to 60-1, and in bull markets, this ratio can compress towards 15-1. If this ratio reverts to the mean, given the current gold price, the fair value of silver should lie between $150 to $200 per ounce. Second, regarding inflation-adjusted price, the 1980 silver peak was $49. Adjusted for CPI inflation, that price is equivalent to approximately $170 in today's purchasing power. Thus, at current levels, silver remains significantly undervalued compared to its peak purchasing power in the past. 2026 to 2027 outlook. Based on the supply-demand model and macroeconomic factors, rate cuts, weakening USD, geopolitical tension, I forecast that the silver bull trend is sustainable and structural. We cannot rule out significant volatility due to spasms in the derivatives market. However, the risk is heavily skewed to the upside. When inventories breach critical technical thresholds, for example below 50 million ounces at COMEX, market sentiment will shift from speculation to panic buying to secure production supply. The current texture of the silver market is not merely a standard commodity price fluctuation. We are witnessing the convergence of a perfect storm. The greatest investment opportunities often arise when the market realizes the dislocation between price and value, and with silver, that gap is wider now than ever before. Thank you for your attention.